Good afternoon, everybody. This is Chris Robinson, Robinson at Marketing with today's post-close grain and livestock comments for Thursday, the 22nd day of January. Well, it took 10 days, but we finally got back to where we were in the beans before the report. The report was on the 12th. We hit 1072 and a half this morning in March, and then really got kind of hammered, dropped back down to 60 and a half, 12-cent pullback. Get used to that in beans. I think we're going to see a lot of 15, 20-cent trading ranges in beans as this market figures out what it wants to do. I can't wait for tomorrow because we'll find out if the funds are still long soybeans. They're definitely short corn and wheat, but they were long a little bit of beans. We'll find out tomorrow if they're still long beans. Why would they be long beans when we have a gigantic crop coming out of South America and China is done buying the 12 million metric tons that they promised us? Is there something out there that the market's trying to figure out? So I would take advantage of it. We know new crop beans are not at 1131, right? But traded up to 1080, which again is right where we were before the USDA report on the 12th. So everybody's going to be fixated on $11 now. If you didn't want to sell them at $11 the first time, you might want to the second time. We were just down at 1055, so expect more movement in the soybeans. Corn today up 2.25 cents at 424. But again, it's hard to do anything on a 3-cent range. At least with the beans, you're giving it a little bit of a chance at the 12 or 13-cent range. March wheat got a dime range, finished up 7.75 cents. But March Chicago wheat and March KC wheat is trading at 525. Again, about a almost a 10-cent range in KC wheat. The market continues to try and fight off the risk of making new contract lows in wheat. There is no bullish story out there. Now, we have had excellent exports of wheat, great exports of corn as well. It's not being reflected in the flat price. Contrast that to what's going on in the soybeans. We had some sales to unknown today, but the bottom line is China going to come back and buy 25 million metric tons next year or not? But for all intents and purposes, they've done with their 12 million, which they promised us in South Korea. So we'll see tomorrow. Tomorrow's important. Why? Well, February options expire tomorrow. Now, a lot of you guys, if you're working with me, we have had February dated options on, not only for old crop, but also for new crop. And those options are expiring tomorrow. If you've got protection on, I would resist the temptation to just blow it off till next week or next Monday or Tuesday. I can't tell you how many times I've seen the market um, reconnect once a lot of options expire. So that would be my suggestion to you. Get something on. I don't even care if you just protect it for another week, but I would get something on there as these options expire. In the cattle market, where everybody's getting ready for the cattle on feed, which will be released tomorrow after the close. Nobody really expects anything drastic in that report. Uh, Cash has been trading a little bit lower, but the fundamental problem that has plagued cattle for the past 4 years is the herd's too small. It's going to take a while to build it back. It really got whacked during COVID on that sell-off, and it's going to take a while to rebuild that herd. Now, the good news is we have rallied 35 bucks off the lows in fat cattle after that horrendous sell-off. You got to remember, just back on November 25th, right? 2 months ago, 8 weeks ago, April fat cattle almost took out 205, traded at about a 9 month low. We watched cattle go from 250 to 205 very quickly, and now we've recovered a big chunk of that. So I'm not calling a top. I hope that we go back up and go past 250 if you're a bull, but 235 minus 205, that's $30. That's probably something we'd want to try and protect a chunk of. In the feeder cattle, kind of the same math, right? We had a horrendous sell-off. We went from nearly 380, can't believe that, 378.60. We dropped down to sub $3. We went to 293.30. Again, that was about a 9 month low. Since that low on November 25th, we've rallied back just about 70 bucks, 71 bucks. We hit the high of 65 the other day. We're trading right at 60 right now, 359 and change. So again, I'm not calling a top. I don't know if we're going to go lower. I'm not buying a put and hoping that they pay off. I'm just saying, if you've got 65 or $70 worth of profits on paper, you can set a hedge. And I also want to finish up with this one idea. When we had the sell off, anybody that had puts on versus futures, even for guys that had futures on, if we had big profits on futures, when we felt like that, a lot of it we covered and replaced them with cheap puts because we were hoping for a rally. And when you rally, the puts lose their value. For those of you who had puts and not futures, we had puts that doubled or tripled. We rolled those down. What does that mean? Well, we sold the more expensive one, bought the cheaper one, rolled them down, and took the money off the table. And then had a, you wanted to have a 3 or 4 cent option on down on those lows rather than a $15 option. That was a good strategy because lo and behold, we've turned around and gone screaming higher. Now, I did do some math today for some guys that had $5 puts on in March feeders, right? We did 305s. Um, so in that position, we roughly had a nickel tied up into it, if that was a initial position. 305s, now we're trading here, close to 360. If you wanted to, you could spend a couple bucks and roll it up about 25, 30 bucks. Isn't that better to spend $2 and go from 305 to 335 and spend a couple bucks versus if you had sold futures at 305 and made margin calls for $45. So that is the put strategy right there. You keep a floor, it costs you some money. Yeah, you've lost, if you had 5 cents into that put, right now it's worth a penny, but you still have something worth over, and you can take that penny and spend another 2 or 3 pennies and, roll your option up from a 305 floor to 335 or 340. I did the math today in the letter. So that is one a real time situation of where put options are different than having futures on. So if you're interested in learning more about that, give me a call 312-638-8868. The same math can be done for lean hogs. Lean hogs are at new contract highs. Lean hogs have rallied 16 bucks from the low. And again, that's a lot of revenue. And you can spend $1 or $2 and roll your existing puts up. I think you can spend $1 and go up about $6 in the April puts that we have on. And again, I put that all out in the letter. And why would you do that? Well, in case we do roll over, it'd be nice to have a higher floor, right? Would you rather have a floor in feeder cattle at 305 when we're trading 360, and then if we have a big correction, we break back down to 350? You still don't have anything. You really haven't gained anything, right? If we break 10 or 15 bucks. If you roll your floor up, you have a better chance of taking some profits on that hedge. So it's always a decision. It's always a judgment call. This is more of a science, an art versus a science. If there was a math program that you just followed and you plugged it in and go sit on the beach, then we wouldn't have to have markets. We wouldn't have to have market makers. We wouldn't have options. But that's not the world we live in. So hedge what you can. Again, this is Chris Robinson, Robinson Ag Marketing, 312-638-8868. Thanks for listening. And again, give me a call. If you're not getting my letter and if you'd like to take a look at it, robinsonagmarketing.com. Take care.